The legal and regulatory landscape for Series A venture capital has entered a highly adversarial and rigorously structured paradigm as of early 2026. Following a sustained period of macroeconomic volatility and depressed exit multiples, leverage in early-stage equity negotiations has definitively consolidated. Institutional investors now favor aggressive capital efficiency, prioritizing capital preservation over collaborative partnerships. This shift has manifested in aggressive downside protection mechanics and the weaponization of board-level control rights. For C-suite executives and founders, the foundational documents governing corporate control and fiduciary liability have been fundamentally rewritten. The primary catalyst for these shifts stems from the October 2, 2025 updates to the National Venture Capital Association model documents. These model documents serve as the ubiquitous benchmark for United States venture financings, forming the architectural baseline for term sheets. Crucially, the October 2025 revisions formalized several defensive mechanisms that were previously considered bespoke or fringe. Most notably, the NVCA formally introduced mechanics for milestone-based tranched financings directly into the model stock purchase agreement. In this structure, initial capital is deployed upfront, but subsequent funding is strictly contingent upon subjective, board-approved operational milestones. This tranched Series A financing fundamentally alters the target company's risk profile, passing the entirety of the execution risk on to founders. Instead of capitalizing the startup with a single injection of funds, the investor parses the capital into discrete installments. The core legal conflict centers entirely on the subjective interpretation of these milestones and the unilateral power to withhold capital. If an investor determines a milestone was met insufficiently, the startup is immediately starved of operational capital. Furthermore, companies must remake their representations and warranties at each closing. Material adverse changes legally absolve the funding obligation. This dynamic leaves founders under the constant threat of insolvency, often forcing the executive team into emergency bridge financing. Compounding this operational hazard is the aggressive implementation of punitive pay-to-play provisions during distressed rounds. To combat the free rider problem, investors force existing preferred stockholders to participate in new funding or face severe penalties. The October 2025 NVCA updates introduced anti-circumvention language designed specifically to enforce these penalties with lethal efficiency. These new provisions temporarily suspend a stockholder's right to convert their shares prior to the closing to preserve their equity. Non-participating investors are forcibly converted into common stock at highly punitive ratios, often 10-to-1. This strips early angels and executives of their protective provisions, voting rights, and crucial liquidation preferences. The ultimate bottom-line financial impact of these weaponized term sheet provisions is terminal dilution for foundational stakeholders. A deeply pervasive conflict also arises from the doctrine of dual fiduciary duties within corporate governance. In standard transactions, the lead investor requires the appointment of a designated representative to the company's board of directors. These corporate directors owe unyielding fiduciary duties of care and loyalty to the corporation and its stockholders as a whole. However, a venture-appointed director simultaneously owes rigid fiduciary duties to the limited partners of the fund they represent. In a distressed or downside scenario, the economic interests of the preferred and common stockholders violently diverge. The market standard remains a 1x non-participating liquidation preference, ensuring venture funds recoup their initial investment first. If exit value falls below this aggregate preference stack, the common equity is rendered entirely worthless. Conflict erupts when directors initiate a premature sale to harvest cash reserves via preferred liquidation preferences, extinguishing common equity. This exact scenario is actively being litigated in the Delaware Court of Chancery in the ongoing case of Shafi versus Cheen. Founders allege venture capital directors breached fiduciary duties by forcing premature dissolution to protect the downside of their limited partners. Vice Chancellor Will denied the motion to dismiss, validating that dual allegiances subject directors' actions to rigorous judicial scrutiny. Courts will not summarily dismiss claims where preferred shareholders use board dominance to extract cash reserves at the expense of founders. A parallel conflict regarding transaction fairness was scrutinized in Way versus Levinson over Amazon's acquisition of the startup Zoox. Holders of common stock alleged the transaction disproportionately enriched preferred shareholders while leaving zero residual value for common equity. The rigorous entire fairness standard confirms that rights negotiated to protect institutional capital routinely invite severe litigation from disenfranchised founders. In early 2026, the Delaware Supreme Court issued landmark rulings altering corporate governance and restrictive equity covenants. The most systemic shift stems from Rutledge versus Clearway Energy Group, upholding the constitutionality of Senate Bill 21. This codifies a procedural safe harbor for transactions involving controlling stockholders, shielding directors from equitable relief if properly approved. This significantly reduces long-tail litigation exposure for venture funds exercising control over portfolio companies during down rounds or asset sales. The ruling restores predictability, allowing institutional investors to restructure distressed companies without the paralyzing threat of continuous lawsuits. In the realm of restrictive covenants, the Delaware Supreme Court delivered two highly consequential opinions impacting executive retention. In North American Fire versus Dorley, the court ruled that equity units subject to forfeiture constitute valid consideration for non-compete agreements. The decision emphasized that consideration must be measured at the time of contract formation, not at the time of enforcement. Conversely, in Fort Line versus McCall, the court affirmed employers cannot bypass strict reasonableness reviews simply by seeking monetary damages. This decision cements the critical distinction between traditional restrictive covenants and valid forfeiture for competition provisions. To secure protections, companies must pivot toward mathematically precise forfeiture provisions that operate as enforceable financial disincentives. Simultaneously, the federal regulatory apparatus has drastically altered the diligence requirements for syndicates with the Coins Act of 2025. With a $150 million enforcement budget, the Coins Act aggressively expands the outbound investment security program. The legislation targets covered technologies, including hypersonic systems and high-performance computing, mandating exhaustive supply chain diligence. Regulators transitioned from simple revenue screening to a complex direction or control test to identify geopolitical influence. The updated NVCA documents now require companies to affirmatively declare national security compliance under penalty of fraud. Non-compliance guarantees draconian civil penalties, forced divestitures, and absolute cap table toxicity for unprepared enterprise risk managers. A startup flagged by the Treasury Department becomes functionally uninvestable, resulting in the permanent destruction of the company's exit trajectory. Finally, strategic risk escalates with the implementation of the highly aggressive conflicted director provision in the voting agreement. This mechanism allows allied stockholders to define a conflicted director as any member affiliated with an entity engaged in commercial litigation. Institutional investors risk their board seats being stripped away during critical disputes, neutralizing their ability to protect their capital.
Executives prioritizing preferred liquidation over common equity without procedural safe harbors face years of invasive discovery. Standard corporate exculpation clauses cannot shield directors against claims of bad faith self-dealing in these hostile environments. Enterprise risk managers must now engineer bulletproof restrictive covenants and mandate absolute geopolitical mapping of counterparty agreements. The legal conflict within a Series A financing highlights the structural divergence of economic incentives between preferred and common stockholders. Without strict adherence to statutory safe harbors and meticulous compliance frameworks, enterprise value will be destroyed.
Any distressed exit will be entirely consumed by attritional, value-destroying litigation from disenfranchised equity holders. As the 2026 venture ecosystem navigates these stringent realities, acute vigilance is the only survival strategy. Subscribe for more insights on the laws that shape business. The law doesn't wait.